Hey everyone, and welcome. So, March is Women's History Month, and if you're in the mortgage world like we are, it's a really great time to stop and think about something absolutely fundamental to financial freedom: access to credit. Today we're going to dig into the story of our fair lending laws, why they were so desperately needed, and most importantly, what they mean for all of us today.
You know, this statement right here, this is why we have the compliance standards we have today. It's so easy to just take it for granted, but every single fair lending rule on the books exists because of a long, hard struggle. These aren't just rules, they're rights that people fought for and won.
To really get why these laws are so critical, we have to rewind the clock a bit. Let's go back to the time before 1974. The lending world back then was, and I'm putting this lightly, a completely different universe, especially for women.
And here's the really wild part. This stuff wasn't just some bad apples having a bad day. It was all perfectly legal. Think about it. A lender could demand a woman get her husband or even her dad to co-sign a loan even if her own finances were rock solid. They could ask super invasive questions about her plans to have children. They could deny her credit just because she was single. Or get this, just decide to count only half of her income when figuring out if she qualified. It's just incredible to think about.
And that right there, that gets to the real heart of the problem. The whole system wasn't built on smart financial analysis or actual risk. Nope. It was built on social stereotypes and outdated ideas about a woman's place in the world. Decisions weren't about the numbers, they were about bias.
Well, thankfully, people started to challenge that system. A whole series of groundbreaking civil rights laws got passed that completely changed the industry and finally wrote fairness and equality into the law.
The Equal Credit Opportunity Act, or ECOA, was the absolute game changer in 1974. I mean, just look at the difference here. It took what was standard procedure, legal discrimination, and made it flat out illegal. It got rid of those inconsistent bias standards and said, nope, from now on, underwriting has to be consistent. And it forced lenders to actually explain why they denied someone, thanks to mandatory adverse action notices. ECOA didn't just tweak a few rules, it basically forced the entire industry to grow up and get professional.
And other major laws helped build on that foundation. The Fair Housing Act tackled discrimination across the board in housing. Then you had the Community Reinvestment Act, which went after the problem of redlining by making banks prove they were actually serving all the neighborhoods in their area, not just the wealthy ones.
But here's the thing. Just because those obvious, blatant forms of discrimination are illegal now, that doesn't mean the problem just disappeared. It just got sneakier. The challenges we face today are often way more subtle. Sometimes they're not even intentional, but the impact can be just as bad.
So let's talk about redlining for a second. Historically, this was literally drawing red lines on a map around minority neighborhoods and just refusing to lend there. And while all kinds of women were hurt by unfair lending, this practice was devastating for women of color, creating these massive barriers to building wealth that we're still dealing with generations later.
Today, redlining doesn't look like a guy with a map and a red pen. It hides in the data. It can look like a pattern of just not marketing in certain zip codes or having denial rates that are way higher for a specific group without clear, documented, risk-based reasons. You can find it in pricing patterns or seeing unequal community outreach. The real risk today is often found in the overall pattern, not just in one single obvious action.
And this is probably one of the most critical things for any mortgage pro to understand today. You don't have to mean to discriminate to get in trouble. What really matters is if your policies have a discriminatory impact. It's what's called disparate impact. Okay, for example, let's say a lender sets a minimum loan amount of, say, $200,000. On the surface, that sounds neutral, right? But what if that rule effectively locks out entire neighborhoods where home values are lower, which might just happen to be predominantly minority communities? Well, even if that wasn't the goal, that policy has a disparate impact. The effect, not the intent, is what the law looks at.
So why are we talking about all this history right now? Because getting fair lending right isn't just about avoiding fines and penalties. I mean, yes, it's about doing the right thing, but honestly, it's also just smart business.
Check this out. Single women are now the #1 fastest growing group of homebuyers in the entire country. That is a huge, powerful force in the market. So ignoring this group or serving them poorly because of some outdated assumptions isn't just a compliance risk, it's a terrible business plan. Fair, inclusive lending is how you serve and win this absolutely critical market.
So how do you make sure you're doing it right? It really boils down to these fundamentals. You've got to apply every standard to every file every single time. No exceptions. Be transparent. You have to check your own assumptions, like never suggest a woman add her spouse to strengthen the file if she qualifies perfectly well on her own.
Follow your denial protocols perfectly, and make sure your marketing truly welcomes everyone.
You know, this all leads to a much bigger idea. Being a mortgage professional, it's more than just a sales job. You are a gatekeeper to what is often the single largest and most important financial opportunity in a person's life. That's a huge responsibility.
So the next time you feel like you're drowning in compliance paperwork or sitting through another training, just try to remember what these rules actually stand for. They are the pillars of a fair system. This isn't just red tape. It's the result of that long fight for financial independence. It represents a deep commitment to fairness and to holding a system accountable that, for a long time, had none.
And this really says it all, doesn't it? It's not some add-on. It's not a nice-to-have. It is the very foundation of a trustworthy, ethical, and yes, successful mortgage practice. It's the bedrock of our profession's integrity.
So, as we wrap this up, I want to leave you with a few questions to ask yourself. Just take a moment this month to honestly reflect. Are my daily practices truly 100% consistent for every single person who applies? Is my marketing actually reaching and welcoming my whole community? And are my conversations completely free of old, outdated assumptions? Answering those questions honestly, that's how we honor this history and uphold the integrity of our profession every single day. Thanks for joining me.